We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. If you're an investment financial advisor and you have clients who are about to retire, creating a tax-efficient drawdown strategy is really important. And here to talk with us about that is Schyler Adams from Allianz Life Insurance Company. Schyler, welcome.
Hey, thank you, Robert. Thank you so much for having me.
A pleasure. So for the benefit of our listeners who may not be familiar with you and your work in Allianz, do you mind giving us a brief description?
Yeah, absolutely. So my name is Schyler Adams. I am the Director of Advanced Strategies and Planning Platforms at Allianz Life. A few years ago, I started our fintech team and really helped us kind of dive into the RA space regarding, trying to figure out a way from a fiduciary standpoint to show the beneficial impacts of our products. Whereas, when most people think of annuities and the offerings of an insurance company in the past, it's almost like their entire business is here within their tech stack. And if they want to incorporate something like a annuity, it's kind of over here on the side in its own illustration, not really understanding, is this actually beneficial for the client or not? But with my role, when it started out a few years ago, the focus was really behind how do we take what used to be, kind of like an insurance product over here on the side and incorporate it into the financial advisor's business, particularly in the fee-based space, so that they know from a fiduciary standpoint, does this make sense for the clients to implement into their financial plan or not? And can we seamlessly integrate it into that advisor's business, making sure that it is part of every portion of their tech stack, whether it be their financial planning software like a eMoney, Money Guide Pro, Right Capital, so on and so forth, or portfolio management and data analytics software such as Ryan, Black Diamond, Tamarack / InvestNet, and then, even part of the CRM, if it's something like a Redtail, for example, really diving into the advisory space, but also making it seamless for the advisor to incorporate us into their business. And then also from the Allianz standpoint, obviously, we are a German-owned company. Here in the U.S., we manage about $170 billion in AUM, where we typically are known for our fixed index annuity space. We've really grew into the registered index-linked annuity space. And we have made significant investments to make it easier for advisors to do business with us. We seamlessly integrate with financial planning platforms and create fee-based products that you can draw the fee straight from the product, which previously, if you're going to bill against an annuity, you had to bill from a separate account, which obviously isn't ideal. That is a long-winded answer to a very simple question. I'm sorry that was a lot to explain, but hopefully that kind of gives you a little bit of background of what I do and kind of where we're at for not only myself, but Allianz Life as we're working into this RA/advisory space, and particularly partnering with associations such as the Investment Wealth Institute has been huge for us, just because the advisor that we are trying to reach is obviously very intertwined with you guys and what you guys offer as well. So this is a great opportunity for us. We appreciate the partnership.
Yeah, we do too. And you may recall that we recently published a paper in the Retirement Management Journal that looked at RILAs and the levers that can be used to improve outcomes for clients of advisors who are seeking retirement income.
Yeah. Absolutely.
Yeah. So talk more a little bit about, this I don't think advisors ordinarily associate fintech with annuities. Talk a little bit more about what you're doing to grow in that world of the business.
Yeah. So when you think about fintech, kind of as I mentioned earlier, particularly in the financial planning space, the great thing about what fintech or the financial planning space allows us to do is it allows us to look at quantitative data and empirical evidence as to whether or not a adjustment to a financial plan makes sense, particularly when we are looking at the fiduciary standard, right? Like the fiduciary standard, typically we want to back that fiduciary standard up by quantitative evidence or quantitative data. So when we look at the financial planning space, we at Allianz think is very important, which we've been able to figure out when you kind of look at the big players in the financial planning softwares, how to incorporate our products so that, from an actuary perspective, we're comfortable replicating them within the software. And, we've been able to now show within the major financial planning softwares whether our product makes sense to incorporate into a financial plan, or if a client owns our product, how to incorporate it into their balance sheet so their balance sheet is up to date and reflects all of their financial assets and outlooks. And the great thing about it from not only a carrier perspective from a suitability standpoint, but then the advisor perspective from a fiduciary standpoint is when we look at the data that the software provides, we know that, yes, this might make sense to incorporate, or no, this does not make sense to incorporate. We need to look at different solutions. And there might be situations where we know from our registered index-linked annuity how it works and its features that we're probably going to be a good fit for our client based on things like net worth, age, when they're looking at drawing on down income, what their tax situation is, things like that. We'll have a pretty good idea from a starting standpoint whether we may make sense or not. But if we don't make sense or not, we are also, from a value perspective, able to help kind of guide the advisors that we're working with to a solution that may be a better option. Where we kind of stand on one of our major pillars is increasing income. Increasing income is a great solution if your client has longevity on their side, right? So if they're either turning on income earlier, or if they are expected to live longer, increasing income can be very beneficial to their financial plan because of the impact that it can have on other assets in a variable sequence of return environment. However, when we look at situations where clients do need more guaranteed income and maybe longevity isn't on their side, or they're, much older than the typical client that would be turning on or purchasing an annuity, well, then we know probably a flat distribution with a higher payout up front is going to make more sense. How do we find that solution to help the advisor, and how do we show them that this is the best option within their portfolio? And maybe the traditional fixed income strategy for a majority of those clients might be the best option, but at least we have different levers to pull within the financial planning software to really make sure that we're making the best choice, not only for our advisors, but most importantly, their clients.
We started by saying that the topic is about tax-efficient drawdown strategies. I take it that the technology allows advisors to determine what is the most tax-efficient strategy given the use of annuity or RILA or whatever.
Yeah, and with this presentation, it's really hard from a carrier perspective, and I'm sure maybe you guys hear this all the time, or I'm sure you get this feedback when advisors are watching presentations or listening to something like this, that when you're talking to somebody from Allianz or a different carrier out there, like, they don't want it to be product focused, right? And it's really hard from a carrier's perspective to create a presentation and not have any product in there, because obviously the goal is to show the value. We can show the greatest amount of value that our individuals like myself can add to a practice, but at the end of the day, if we're not distributing product, we're not going to be very successful. So within this presentation, what we wanted to do was we really wanted to focus on the value that Allianz can add from the in-depth knowledge our fintech team has within the financial planning softwares and the advanced strategies that they understand how to implement and analyze within the softwares. And, in this particular instance, focus on Roth conversions. Now we can do things like optimizing Social Security, comparing things like pension payouts to different solutions out there. But in this particular situation, we focused on Roth conversions, and the focus is on, does it make sense to pay tax now versus pay taxes down the line? And kind of like we mentioned with products previously, it's like, well, a lot of that depends on your client situation, right? it's very easy if we know the exact date in the future that our client's going to pass away to make a financial plan for them, whether it's purchasing an annuity, buying Social Security, or optimizing Social Security, doing Roth conversions, so on and so forth. But unfortunately, we do not know for anybody what that exact date's going to be. So we kind of need to look at it from an umbrella perspective and be like, okay, if we look at various dates and times in the future, whether it's age 78, age 85, age 95, how do we best put our clients in a position to successfully and efficiently fund their expenses at each one of their ages, leaving behind, maybe something like not only the largest legacy, but the most tax efficient estate transfer possible, things like that. And a lot of times when we look at the benefits of a RILA, it's always focused on the accumulation benefits, right? You take non-qualified assets, you put it into a RILA, you get tax deferred growth. And that's where a lot of people tend to focus on. But, a lot of times what we found is people are so focused on the accumulation stage that they get to retirement and there's no decumulation or efficient decumulation strategy set up. So what we're really focused on here is kind of that decumulation or that transition stage as we enter our retirement time frame and saying, okay, let me show you how we can do various drawdown strategies with and without a registered index-linked annuity, and how we can tweak those strategies to really offset two of the biggest, actually I would say really help try to offset or at least hedge against three of the biggest concerns as clients go into retirement, which is increasing taxes, which ties into inflation, and longevity. So that's really what the presentation is focused on, is kind of building off a current scenario that it's not just going to be one tweak to that plan, and it's going to get the clients from let's say a 55% probability of success up to a 90% probability of success, because that's just not realistic. But how do we keep making minor tweaks, whether it's a traditional Roth conversion, implementing a solution with increasing income, maybe combining those two solutions, maybe doing one of those solutions within the other to get our clients from, that 55, 60% probability of success up to that 85, 90 plus range. So really building off of it. And, yes, in some of the cases, utilizing our product, but utilizing our product as a portion of the solution, and not saying, here, you have a 60% probability of success. Let's just take 50% of those assets and put them into the annuity, because that's not how real life works, and that's not realistic. So, maybe it's 10, 15, 20% of the assets, but how do we make sure that we're tax diversifying those assets along with other assets outside of the annuity that we're looking at reallocating to become more efficient with the drawdown strategy and getting our clients to where they need to be?
Yeah. So let me just back up for 1 second for the benefit of our listeners who may not be familiar with the RILA. Is it okay if you could just briefly describe the features and benefits of it?
Yeah, absolutely. So with a registered index-linked annuity, it's got more features of a fixed index annuity than I would say it does with a variable annuity. The only reason I say that is because, some of them may have sub-account options, but we really don't see any flows within the sub-account options like you would a variable annuity, which is based on all sub-account options. You're going to be able during the accumulation phase to basically customize your downside protection option. So a fixed index annuity, you'd have 100% downside protection. With a registered index-linked annuity, you're going to be able to maybe put a portion of your assets within the product in 100% protection bucket. But you could also select between maybe a 10% floor or a 5% floor instead of being 100% protected. Now, if you're potentially going to lose, let's say 5% in a given year, what the insurance company will do in return is they'll increase your potential return. So maybe instead of, and these are just very basic numbers, instead of, your worst case scenario being a 0% loss, best case scenario being a 5% return for the year, maybe now your worst case scenario is a 10% loss with a 15% potential return for the year. So there's just little levers that you can kind of pull within these products that allow us to basically customize it to the client's risk tolerance a little more. They probably fit a lot more for those clients that are in that growth stage versus a client immediately ready to turn on income. But then once we do turn on income from these products, if they do have an income rider, it's at that point in time where they kind of shift and work very, very similar, if not almost identical to an index-linked annuity where we continue to track the index. There's no loss potential during the income phase. We still track up to a potential cap, let's say 6%. And in Allianz's, within Allianz's products, when we track that index each year the market's up, you get an increase in your income up to that cap. And that's a very high level overview. Products can be very, very confusing. They can, for us, for example, you have 21 different combinations of index options and downside protection options. Really what it comes down to is, how do we benefit the client most? Well, the client benefits the most once they're inside the insurance company's pockets. When are they inside the insurance company's products? When their account value goes to zero. Now, when do we anticipate that happening? And how old is the client at that point in time is really the gist of it, but that'd be a very simple way of looking at it.
Perfect. The other thing you mentioned is, and I think this has been a challenge for investment advisors for a long time, is how do I assess the value of the annuity on my client's balance sheet on their net worth statement. Mm-hmm. Can you talk a little bit more about that and how that's done?
Yeah. So when you assess the value of an annuity on your balance sheet, well, we can see that within a balance sheet now within all the different financial technology softwares. Obviously, that's just going to give us a number at a certain point in time. But when we really assess what does the annuity do for us, it's not necessarily what does the annuity generate for us just from the annuity itself, but what is the impact that this annuity has in the entirety of our portfolio. And I kind of hesitate to say the entirety of the financial plan because it's not going to impact things, right, like your business or your mortgage or those types of liabilities. But like if we just look at the portfolio in general, as I mentioned earlier, really when the client wins or when the advisor wins is when they draw down that annuity to zero. And now they're getting an increasing distribution stream off a depleted asset. Well, what does that do? It is going to really at that point in time, let's say client turns on income at 65, 78, there's no account value left. Well, that's when their internal rate of return, not only on the product, is really going to see a spike. But also that's where you're going to see a increase in the internal rate of return on your overall portfolio with the annuity included in it. And we talked about a little bit earlier, the annuity providing, some form of downside protection on the assets within the annuity during the accumulation phase. But when we look at the decumulation phase, especially for our product where we allow you to have an increasing income stream that's going to last the rest of your life on an asset that's drawn down to zero. When we look at what that does, well, that actually kind of gives you a form of downside protection on the rest of your investable assets, right? Because 25 years down the line, if you get an increasing income stream and we see a market that's going up and down, and I don't know if people can see me right now, but I'm moving my finger up and down. Well, what we're hopefully able to provide with this increasing income stream, if we're trying to be as efficient as possible, is in those down markets, we're not withdrawing from, let's say, our qualified assets or other investable assets as much as we would be in a down market without this income stream within our overall financial portfolio. And, this isn't just someone from an annuity company saying this, even though it might be perceived that way, but really this is the only income option, or this is the only portfolio option that can provide this type of solution that will take pressure off the other assets, just because traditional fixed income, regardless of if you manage the traditional fixed income, if you ladder it, if you do this and that, and I understand fixed income pretty well because that's the underlying investment of what we're pricing our products with, it's just impossible to provide these features to an overall portfolio with just no matter how good you are at, managing bonds, the impact on the rest of the assets is very hard to compare.
So talk a little bit about the feedback you received from the IRA space.
Some feedback that we've received when it comes to doing presentations is to avoid doing product pitches. So that's why I always hesitate to go too much into product. But other than that, we've started 5 or 6 years ago in the IRA space. We didn't have any background in the space at all. Our relationships were in the wirehouse channels, the larger independent BD space, FMOs, or field marketing organizations, which are all what helped build our business 10, 15, 20 years ago. When we got into the IRA space, we didn't have a product that was ready for the IRA space, primarily because we weren't able to draw a fee from our product, and there wasn't access to the principal or account value. Both things that we didn't realize were as important to IARs because we simply didn't have the experience there. We've taken that feedback, and now when you look at particular registered index-linked annuities, we've got a product that we feel fits a lot better in the IRA space. The advisor is able to draw a fee directly from the annuity if they choose to, which makes it seamless to do business with Allianz, which was not the case previously. Let's say you have custody at Schwab or wherever you manage assets and everything goes smoothly there, and then it's a huge pain to have an annuity at Allianz because it doesn't seamlessly fit within the rest of your tech stack. We've made huge investments in order to be able to integrate because even if our solutions are strong, it doesn't matter if we can't seamlessly fit into your business. 5 or 6 years ago, when we kind of started down this path of the IRA space, we weren't ready from a product standpoint or probably like a business development standpoint. And just by getting the feedback from advisors, as we've grown in this space, that's really probably the 2 biggest things that I would say. And then obviously there's been some other partnerships like outsourced insurance departments in order to also make it seamless to do business with us if you only carry, let's say you're 65 or have no insurance license, and different licensing situations that have grown over the years, or I shouldn't say grown, but evolved to make somebody who 5-10 years ago couldn't do business with Allianz based on their licenses can now do business with us. So I'd maybe add that to probably the 2 or 3 biggest things regarding feedback we've gotten from advisors that we've made investments in to more so fit into their business and make us a potential partnership for their RA firm.
So, Schyler, we've covered a lot of ground. Anything we missed or anything that just bears reemphasizing?
Oh, man. What I would just say is thank you to you guys again for partnering with us and allowing us to have kind of this platform to talk about what we're doing, because it's really hard being an insurance carrier to kind of have a platform where people can, see us discuss, or have conversations like this that aren't focused on product and, promoting all this. We feel like we are making steps in areas that aren't something that you're going to see if you just walk past us at a booth or something like that, So we really appreciate the partnership with the Investment Wealth Institute. Obviously, your guys' partners and advisors are the cream of the crop when we look at especially the RA space. So we just think it's a huge growth opportunity, not only for us, but obviously I think there's partners that we can hopefully bring to the table and you guys find beneficial as well. So I just want to say thank you for this. And I think I speak for everybody at Allianz when I say that.
Thank you, Schyler. Thank you so much, Schyler, for sharing your knowledge and wisdom with our listeners. It's greatly appreciated.
Thank you. And feel free to reach out if you have any questions.
Yeah, you know what? Just do that again, because I think I hit pause. So let me just hit that. I'll just say 3, 2, 1. So, Schyler, thank you ever so much for sharing your knowledge and wisdom with our listeners. It's greatly appreciated.
Thank you, guys. We really appreciate it. Please, if you do have any questions regarding anything that was discussed today, feel free to reach out to either myself, which is just first name dot last name at allianzlife.com, or you could shoot an email to ria@allianzlife.com, and we'll get your questions into the correct hands. So thank you, everybody.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.